Namaskara people, this is Tejashwini Gowda. In today's class, let's learn about the preparation of final accounts of sole proprietor. So in today's class, we will be basically considering, probably there might be one or two parts which will be coming for this particular class. Let's look into it and let's see how much we can study and what we will be doing. Okay, great. So, before starting the class, I just wanted to give a small information, that is, before watching this video, please go watch the previous video, because that previous video with respect to the classification of accounts has the basics of passing the journal entries, and this complete session of this class will be based on how to pass a journal entries for sole proprietors, that is for final accounts. How are you going to pass the journal entries? We'll see things in depth, but if that video has been watched, it will be much more helpful in this particular classes. So I'll tell you like how we will move forward with this class. We will be concentrating only on the revision part. We will be concentrating only on the revision part, and this revision part, whatever is being taught, will not contain major practical problems. It will have the theory concepts, that is brush up of the concepts, and also with respect to understanding of the concept. If you are watching it for the first time, yes, this video can be watched, because there is understanding of the concept. But if your intention with respect of watching the classes is solving the practical questions, in this class we are not solving any practical question. Okay, so with this understanding, let's start our classes. We are here, we are studying about the preparation of final accounts. Final accounts of whom? Of sole proprietor. Of sole proprietor. Who is the sole proprietor? Can I say sole proprietor is the person? He is the owner of the business. See, there is one person. This person wants to establish a business. He has multiple options. He can either establish it as a company. He can either establish it as a firm. If he needs to establish it as a firm, there should be other people also. But if he is establishing as a sole proprietor, can I say this person is the sole owner and he can enjoy both profits and losses. He can enjoy profits also, he can enjoy losses also. So for these people, in order to have a proper understanding of how much is the profit, what is the amount that is coming in, what is the amount that is going out of the business, this is the business. You should be having record of everything, right? What is the purchases, what is the sales, how much is the recording should be done. Everything should be understood. That is the reason why it is necessary to prepare the final accounts of the sole proprietor. Now, let's consider this. Let's try to understand for a non-manufacturing business entities. For non-manufacturing business entity. People, for non-manufacturing business entity, what are the accounts that are prepared? I am speaking with respect to sole proprietor again. This is not for the companies and other things. This is only for the sole proprietor. For non-manufacturing business entities, the final accounts which are prepared. What are the accounts you are going to prepare ultimately when it comes to final accounts of sole proprietor? The first thing, trading account. The second one is profit and loss account. What did I just say? The final accounts. What are the final accounts that are prepared for sole proprietor? What are those? Trading account, profit and loss account, and balance sheet. Let's try to understand in depth with respect to what is trading account, what is profit and loss account, what is balance sheet in upcoming sessions, in upcoming classes. Now, with respect to this is the overview of what we are studying in this entire chapter. Now, let's try to understand the financial statements. People, what are these financial statements here? Financial statements are those, normally if you are speaking with respect to the companies, financial statement consists of balance sheet, profit and loss statement, cash flow statement, notes to accounts for AS balance sheet, that is accounting standard balance sheet. Let's not get into the technicalities. As of now, financial statement consists of, just understand, balance sheet, profit and loss account, cash flow statement, notes to accounts. Easy. Now, that is for the companies. Now, let's come back to a sole proprietor and see what are there in the financial statements of a sole proprietor. The first thing we can see is the income statement. Income statement. In this income statement, the name itself is specifying something, right? Income. This income statement, you can consider this income statement to be what? Trading account. People, listen to me very carefully. Income statement has trading account and profit and loss account. Trading account and profit and loss account comes under the income statement. But wait, listen. How is it? If you are preparing something called as trading account, that trading account you will get, what is the end result? Either you will get gross profit or gross loss. Any one you can get, gross profit or gross loss. What are you doing with that gross profit and gross loss? You are transferring the same thing to profit and loss account. In the profit and loss account, you are getting something called as net profit or net loss. Net profit or net loss. Now, with respect to the position statement, in this position statement, the name itself is specifying, it is representing the position of the business. In this position of the business, we have balance sheet. In this balance sheet, what will be there? That's very simple here. Balance sheet, what is specified in the balance sheet? We have assets and liabilities in the balance sheet. This balance sheet represents what, you know? This balance sheet represents the position of your assets and liabilities. Your position of assets and liabilities. Now, easy people. What are we studying? We are studying with respect to the financial statements. This financial statements is divided into two things. Just give me a moment. There is some connection issues. Just give me a moment. Okay, everything is set, I guess. Now, okay, there was some technical issues. I'm sorry, apologies for that. And now let's continue. We were speaking about this position statement, income statement. Income statement, what we have trading account. Through trading account, what we will get? We'll get something called as gross profit or gross loss. Through income statement, we will, after preparation of the trading account, we'll transfer the gross profit and gross loss to profit and loss account. In this profit and loss account, we'll get net profit or net loss. After that, moving forward, we will have position statement. That position statement is what people will be preparing the balance sheet. What does balance sheet represent? Balance sheet represents the position, that is assets and liabilities position. Balance sheet represents assets and liabilities position. Now we have understood with respect, at least we got an overview, like what is there, what are we studying in our sole proprietor. We got an overview. Fantastic. Now let's move forward and start with our hero of our chapter, that is trading account. Trading account. People, trading account, I'll just give you a small clarification with that respect of what will be recorded. Trading account has its format. Before coming into format, let's try to learn how do we calculate closing stock, because this is very basic. Closing stock. People, at the beginning of the year, we have something called as opening stock. How do we get this opening stock? This opening stock is nothing but the closing stock of the previous year. Let's take an example. See, this is, let's consider this is as on 1/4/2022. 1/4/2022. If we are considering closing stock. Example. Now, if I am considering this as an opening stock, can I say this was the closing stock for the year 21-22? That is from 1st April 2021 to 31st March 2022. Whatever the opening stock which I am representing over here is the closing stock of the previous year. Is the closing stock of the previous year. So now, what are we considering? We are considering the opening stock for our first instance. Now, we have closing stock. Easy. Now, we will add purchases for the same. We will add purchases. As of now, what are we studying? We are studying with respect to trading account, but before going into the concept, let's understand how do we get the closing stock. This is closing stock calculation what I am doing. Now, direct expenses. Now, direct expenses. Next, you will reduce something called as cost of goods sold. Cost of goods sold. If you reduce the cost of goods sold, you will get something called as closing stock. Closing stock. If you do this calculation with respect to opening stock is nothing but the closing stock of the previous year. You are bringing it in the current year as opening stock as on 1/4/2000 X and X. Now, after that, purchases. Purchases, what do you mean by the purchases? Purchases during the year. Purchases means to say people during the year. What are the direct expenses? The expenses which are corresponding to the purchases, that is directly incurred with respect to the purchases. Now, cost of goods sold, COGS. This COGS, if you are subtracting, you will get closing stock. Now, we'll try to understand this thing in a better sense. People, normally this formula, whatever closing stock I told, let's try to understand this closing stock calculation over here. COGS, cost of goods sold. The formula for calculating the cost of goods sold is opening stock plus purchases minus direct expenses, plus direct expenses minus closing stock. If you do this formula, you will get the cost of goods sold. People, try to understand. With respect to opening stock, can I say this is the stock which was pertaining or prepared, WIP, work in progress. It might be work in progress, it might be raw materials, it might be finished goods also, anything. If it's provided in this year, it means to say this year I am going to sell those products. Those products which I am bringing it in, or those goods which are bringing it in opening stock, I am selling those goods during the period. Now, whatever the purchases I am making, I might be making the purchase of raw materials, right? Raw materials, whatever I am bringing, or whatever the material for that matter, whatever the finished goods or the material, anything for that matter. If I am bringing it, can I say I am converting the same? If it is raw materials, I am converting. If it's not the raw materials, if I'm just in the retail business, let's consider, where I'm just trying to bring some finished products like the shampoos or the biscuits or anything for that matter, what am I doing? I'm bringing in a wholesale, I'm selling it in retail so that I can make some profits. That is what I'm doing over there. That is purchases. Plus direct expenses. What are the expenses which is directly incurred with respect to the purchase, like transportation, carriage, inwards and all will be included over there. Minus weight. Why am I specifying this closing stock as subtraction? Why am I not adding it? Why minus closing stock? The reason behind that is, people, previous year closing stock, what did you do? You bought it in the current year. You bought it in the current year. But Similarly, this closing stock, whatever is there here, you are specifying that stock is lying in the business as on 31st March X and X year. As on the close of the year end, this stock is still lying in your business. If this stock is still lying in your business, can I say this closing stock, whatever you are specifying over here, will be recorded as opening stock in the next year. As on 1/4, it will be recorded as opening stock in the next year. Let's consider this is 2021. This is considered, this closing stock, whatever I am writing here, will be considered as opening stock as on 1/4/2021. Can I say this closing stock was recorded as closing stock for the period 1st April 2020 to 31st March 2021. But the same thing has been considered as opening stock for 1/4/2021 to 31st March 2022. It is considered as stock over in this particular period. That is the reason why we are subtracting closing stock. The reason behind that is very simple. Closing stock will be considered as opening stock in the next year and it will be included in COGS calculation. That is the reason. Now, if you try to understand, if you have understood this, then it is easy for you to understand this. What did I say with respect to COGS formula? COGS is opening stock plus purchase plus direct expenses minus closing stock. Can I say this closing stock, whatever I am specifying over in this particular thing? This closing stock is nothing but movement of the place. Movement of the place. If I put the closing stock on the other side, obviously it will change its sign, right? That is what I have done. I have taken this closing stock from here and I put it over here on the left hand side, and I bought the COGS and I put it in the right hand side. If in the question all the information with this aspect, this is provided, this is provided, don't worry, just use the COGS formula to find the closing stock. If in the question all this information is provided, this information is provided, this is not provided, don't worry, just put it on the other side, just put all these things on the other side. If you subtract opening stock from COGS, direct expenses from COGS and add closing stock to it, you will get the purchases value. It is just taking the positions from one right hand side to left hand side and left hand side to right hand side in order to know what is the exact, amount which has been missing. You can easily find it out using what? Using the COGS formula, provided one information is missing. One info is missing. Now, this is how to calculate closing stock, very important. Before preparing the trading account, you should be having closing stock, opening stock, purchases, sales value. Otherwise, you can't prepare the trading account. Now, great people. Let's look into the format for the same, right? We have been specifying, we have been talking about trading account. Arey yaar, what is trading account? See, let's look into the format for the same. Format is very simple, people. Trading account of dash, that is, dash means to say some X person, for the year ended, dash, some X year. Okay, now let's look into the format. This goes with the particulars, this goes with the rupees, this is particulars, this is rupees. Now, with respect to this one, the first is to opening stock. Please understand the format. I will explain everything with aspect of the entries which is happening over here. Opening stock. Let's have an overview with respect to what is there in trading account. Then let's understand everything, each and every minute thing in this aspect. Now, let's have little patience. Let's look into the format first. To purchase account, less purchase written. To direct expense. In direct expenses, you can have many things: freight and carriage, customs and insurance, wages, gas and water fuel expenses, etc. Any expenses for that matter. Now next, by sales account. Only direct expenses will come in trading account. Okay. Now indirect expenses will go to your profit and loss account. Now, by sales account, you will reduce your sales written. Then by closing stock. Now, as a result of this trading account, you can either have credit balance to be more or debit balance to be more, right? Very logical. If you have credit balance to be more than the debit balance, congratulations, we have gross profit to gross profit. If debit side is more than the credit side, then we will have gross loss carried forward. Carried down. Carried down. This is the format for the trading account. People, please do have some patience with respect to what is being taught. Now, let's start our trading account items. People, now we have seen so many things, right? We have seen opening stock, we have seen purchases, we have seen purchase return, direct expenses, sales return, closing stock, and also gross loss and gross profit. Let's try decode everything. Now, trading account items. First thing which is there is opening stock. That is opening inventory. Opening stock or opening inventory, anything is fine. In this opening inventory, as I explained some few minutes back, this opening inventory is what, people? Opening inventory is nothing but the closing inventory of the previous year. As this is the closing inventory of the previous year, can I say this inventory is what is? This inventory is your stock, nothing but your stock. Stock is what? Stock is your asset. Asset as what balance? Asset as debit balance. Always remember asset as debit balance. Now, we have understood that asset as debit balance, okay? What is happening is that when did you record this particular inventory as asset? You have recorded this particular inventory as asset in the previous year as on 31st March of X and X year. Previous year you have recorded it as an asset, you have shown it as debit. That is asset debit balance. Now, what you need to do is that you need to reverse the effect of the same because you are selling that inventory during the period. What did I just say? Whatever the debit balance which is shown in the previous year, every asset, when it is written off or when it is no more in the business, what will you be doing? You will be reversing the entry. That is what we are doing. Why are we reversing the entry or why are we reducing it? Because of double entry system. What does double entry system specify? Double entry system specify that every account, that is every expenses income should be written off within that accounting period, and assets and liabilities should be reduced or written off or anything for that matter. If the asset is not there in the business, you should reduce the balance or write it off. If you are disposing it also, you should write it off. Liabilities, when you are making the repayment, you are reducing the value of your liability because to that extent you have repaid, you don't have that liability. That is what we are doing in this opening inventories as well. See, in this opening inventory, can I say to opening stock account? To opening stock account. What is this opening stock, people? Opening stock in previous year it was closing stock. If it is closing stock, it will have debit balance. If I need to reduce the balance of that asset which is no longer in the business, which has been sold, I have to reduce the balance of the opening stock by debiting what? Where am I sending or where am I pushing that opening stock into? Trading account. I'm closing the opening stock and I'm pushing that account towards where? Towards trading account. Now, let's move forward to the second one, that is purchases and purchase return. These two are like brothers and brothers, two brothers. See, what is happening with respect to purchases? Let's try to understand the purchases entry from the initial stage so that we will not make mistakes. When the purchase is made, people, when the purchase is made, when the purchase is made, can I say the purchase is your what? The purchase per can for an instance, purchase can be of two types. Purchase can be purchase of your stationaries or the other small items it might be, or the purchase of fixed asset, or the purchase of any asset for that matter. Purchase can be two types. As of now, a small, if you speak logically, as per me, the purchase should be real account. The reason behind is very simple. As per the real account rules, you are going to record all the assets but not debts. All the assets for that matter. If you are recording each and every assets over there, can I say your raw materials which you are purchasing, your items, that is your WIP which is there, or your finished goods, whatever you are recording, can I specify all those are recorded as assets in your balance sheet? When everything is provided as an asset in your balance sheet, then is it not ideal for you to record the purchase of your raw materials also as asset and show it under real account? It is very logical, right? So I specify this particular purchase as real account. This is, as per me, the purchase of raw materials is asset, and asset always has debit balance. Now, listen, people. When the purchase is made, can I see the purchase? When the purchase is made, the purchase account is debited. I'll go simple as per the real account rules. Debit, what comes in, credit, what goes out. What is coming in? What is coming in? Purchase. Purchase account is coming in. That is the raw materials which you have purchased is coming in, and here you will specify purchase of material Y. Purchase of material Y. You will specify purchase of material Y. I am just giving it the name as purchase here. Purchase account debit. If you are making it as a cash purchase, that is means to say bank transaction also fine, on short settlement. If you are making the settlement at that point of time only, can I say your bank account will be credited? Reason behind the same, your bank is an asset. As per modern approach, asset has debit balance. If you are reducing your asset, then asset should be reduced by crediting. Your asset will be credited if you are reducing the balance of your asset. That is what happening, right? When you are making the purchase, people, if you are making a purchase of 1 lakh rupees here, some material, some wood you are purchasing, will he give it for free or will he take some amount from you people? Obviously, will take some amount from you people, right? So that whatever the amount you are paying, when it was with you, it was your asset. Now you are paying, your asset is reducing. If your asset is reducing, asset has debit balance. If your asset is reducing, you will credit the same in order to give the reduction effect of your asset. That is what happening over here. Purchase account debit to bank account. This is for the purchase being made. This is for purchase being made. Now, listen. Is this done? Great. This is for the instance where you are making the settlement over at that point of time only. What if you are purchasing the goods on credit? Obviously, now any business for that matter, business which is running in a large scale, obviously they require the purchases to be done in credit, giving them a credit period of 60 days or 90 days for that matter. So when payment is made, that is when the payment is made. If the goods are purchased on credit, how will the entry be reflected? Purchase account as usual will be reflected in the debit. Real account rules, debit all, debit what comes in, raw materials is coming in, that is raw material Y is coming in, so that is why you are debiting the purchase. Now, to what you will do? If I am purchasing something on credit, can I say I am obliged or I am liable to pay some amount to Mr. X or to some person for purchasing this material? That purchasing of the material, whatever has been done, that person whom I should give the amount is called as creditor. Who is creditor? Creditor is the person where the business is liable to pay them for the materials procured from them. Those people are creditors. Now, these people I should be liable to pay. Can I say these people are nothing but my liability? Liability always has what balance, people? Liability always has credit balance. Liability always has credit balance. That is for sure. If liability is always having credit balance, so is it not ideal for me to record the liability in first instance in credit only? Making sense, right? Great. Now, this is when the payment is made, that is in the first you are recording the transaction through the creditor, and now you are making the settlement of this creditor. Let's consider this is some 1000 rupees. Let's consider 1000. Now, this creditor 1000 rupees I am liable to pay to that person. In that case, can I say when I am making the settlement, what is happening here? Your bank amount is going out when the payment is being made. I am giving that creditor here. I am telling 1000 rupees, don't cry for that 1000 rupees, I will give you that 1000. Now what you are doing? You are reducing your bank balance. Bank is your asset as debit balance. If you are reducing your bank cash from the whatever the amount from the bank, that will be credited. Easy, that will be credited. Bank account. What will be debited is that when you pay off the liability, when you are making the payment for the liability, that is your liability is getting reduced now. Your liability has what balance, people? Your liability has credit balance. If you are reducing it, you need to debit the same in order to give the nil effect. That is CCC over here. To creditor account debit. So with this instance, can I say this is 1000 rupees, okay? This is 1000. Can I just say whatever the creditor I need to pay them, that is 1000 rupees has been cancelled out now, and now this 1000 rupees whatever I need to pay, I paid. Ultimate effect for the same is the purchase account debited to bank account. But whatever the creditor which we are bringing in is the routing entry in order to have a proper hang of the business, what is happening, with whom we are purchasing, how much we are purchasing. In order to know that effect, we will route the entry through creditor account. Hope everyone understood. This is how purchasing is recorded. Now, let's come to the trading account. How this purchase is affected in trading account. Can I say, people, every account should be closed. Any account which you are opening in your books of accounts should be closed. So for that matter, now we have successfully closed the creditor account. Bank account you cannot close, means to say when you are closing the business or when you are closing this bank account, you will close this bank account. Ultimately, this will be going and reflecting where? In your balance sheet. Easy. It will be reflecting in your balance sheet. You need not worry about it. Now, the account which is remaining is the purchase account. Let's try to understand where this purchase account will go. Now, every account should be closed as I've specified earlier. Now, listen to me, people, very well. This purchase account though should be closed, we know that. So what we will do, we will record the purchase account in the opposite, it has debit balance. If you reduce and put it on this another side, credit side, can I say ultimately you are reducing this one also? You are reducing this account also, whatever the 1000 rupees is there. You're reducing the purchase account also. Where are you pushing that account and closing it? You're pushing and closing it by transferring it to trading account. Trading account, you are recording it. Recording it in where? You are recording it in trading account. This, whatever you have studied with respect to this one, this is for the purpose of understanding how you are closing the account. But whatever you are recording over here with respect to this trading account to purchase account and to whatever the recording, can I say ultimately you have cancelled out the purchase account, you have cancelled out the trading account, creditors account means to say you have closed that account. Now bank account, easy, it will go to your balance sheet. What account is open? Trading account. You have transferred your purchase account to trading account ultimately. This is the entry which need to be considered for the sole proprietor. All these are for the understanding. This is the ultimate entry. Trading account debit to purchase account. Trading account debit to purchase account. Now wait. Let's come to the brother, no? Purchase written. Papa, why should we leave this small tiny brother purchase written, who's always dependent on his elder brother purchase? People, what purchase written means to say, you have purchased some goods. Okay, these goods are over here. You saw some defect with respect to these items. What you will do? Will you keep the defects by yourself in your company or in your proprietorship or wherever the factory is, or will you send it back? You will send it back to the person who has sold it, and you will tell there are some defects in the whatever the products you have said. Please take it back. I am doing a purchase return. So can I say, people, out of whatever the purchase, this is the total purchases you have made. This is the total thing which you are sending back. This is the total thing which you are sending back. If you are sending this back, to that extent of whatever the purchase you have made, you are returning that items to the person who has sold it, and this purchase return whatever is there, can I say logically speaking, you have to give the effect to the purchases only. You have to give the effect where? You have to give the effect in the purchases only. If you have understood the classes with respect to recording of the entries, now you will be easily able to capture this. Purchase is what, people? Let's consider it as real account. Real account. Purchase is real account. If you're making a purchase, can I say it will be debited? If it is debited, if you want to reduce, that is to that extent of whatever the purchase you have made, if you have written it back, can I say you are reducing it from the purchase? And if you are reducing it from the purchase, what will happen to the purchase? Purchases will be credited, because when you are making the purchase, you will debit it. If you are reducing that purchase and sending the little goods back to that person who has sold it, can I say that will be credited to purchase account? Now, what will be debited? People, purchase written is nominal account. Listen. Purchase account is nominal account, but it is contra expense. Means to say, purchase return will not directly affect your trading account, but it will affect your purchases. It will reduce your purchase. It will reduce your purchase. That is, purchase return account will be debited to purchase account. That is, purchase is reduced to that extent of returns which has been made. So, purchase return account will be debited to purchase account. Hope this makes sense. Now, let's try to understand this purchase return in a little more depth manner. Little, not too much, little. Well, purchase return, as I've told, every account, once it is open, it should be closed also. Okay. Purchase account, though, you will close it by passing it to trading account. Whatever the extra additional amount are there, trading account to purchase account. Okay, let's consider this purchase is of 10,000. This purchase return, it's of 2000, 2000, 2000. And can I say ultimately 8000 will go to your trading account, debit to purchase account. Now, this account though ultimately it is cancelled, it will be cancelled out somewhere. Purchase, debit, credit. What about this purchase return? Just give me a moment. Yes. What about this purchase return? Whatever the purchase return which is being specified over here, this purchase return, you are going to credit the same. If I am crediting the same, can I say I have successfully cancelled out the purchase return? But what are you going to debit? People, just to try to think. If purchase account is being debited, can I say in the previous thing you might have seen, in previous example you might have seen this thing. You might have seen this purchase account. When you are making the purchase, you might have paid. Similarly, when you are getting the purchase return, you are sending back those goods to them. No, if you are sending back the goods, can I say they will transfer the amount, or that amount which you have paid already will be received back to that extent of purchase return which you are making. Won't it make sense? To that extent of whatever the purchase return you are making, it makes like to that extent of whatever purchase return you are getting, whatever purchase return you are making, to that extent bank account amount you will be getting credited. So this is with respect to opening purchase and purchase return. Now let's move to the next one. That is, this is very easier. Carriage or freight inwards. Carriage or freight inwards. Carriage or freight inwards. People listen here. What is carriage or freight inwards? Carriage or freight inwards is nothing but when you are making the purchase, you have to get those goods. This is your factory, okay? This is your factory, and this is the factory of the purchase. Like this is the factory of the supplier. They're supplying some raw materials, plastic. Some plastic is purchased, some supplying. There is some distance. To move from this place, the raw materials are in this godown. You have to put it in a truck. This truck should go and it will reach your premises. This transportation which is involved is called as carriage or freight inwards. That is the amount, that is the transportation goods are coming in. The carriage is coming in. That is called as carriage or freight inwards. Now, with respect to this one, normal entry for carriage inwards is nothing but your expense, no people. What balance does expense has as per modern approach? As per modern approach, expense has a debit balance as per nominal account. Nominal account, debit all expenses and loss. Rules. So can I say your carriage inwards or the freight inwards, whatever you are recording, is debited. Carriage inwards or freight inwards will be debited. Let's consider you have made the payment immediately, that is to bank account. Bank account is your what? It is your asset. Asset has debit balance. If it is reducing, you will credit it. Now, after reduction of the same, carriage inwards or freight inwards to bank account. Can I say this bank account will go and settle in where? Your balance sheet. But you need to close this account. What you will do? You will credit it. It is debit. It is having debit balance. Will reduce it by crediting it. Will reduce it by crediting it. So what will happen now? To carriage or freight inwards account is credited. What account is debited? Where are you transferring this carriage or freight inward expenses to? You are transferring the expenses to your trading account. Where you are transferring the account? You are transferring it to your trading account. Now, can I say to this aspect, to this thing, you have successfully cancelled out these account. That is to carriage inwards. Bank will go to balance sheet. Trading account will see forward like how we close our trading account. We'll see. As of now, this expense is cancelled out and we are very successful with that. Now, we'll move to the next one, that is wages. People, whatever the wages you'll pay, yeah, what are wages? This is your factory or this is your organization. There will be employees who are working. There will be many employees who are working. There will be many, not employees, there will be many people who are working in your premises. When the people are working in the premises, you need to pay them the wages, right? If you are paying them the wages, that wages will be called as a direct expense, and that direct expense will go to your where? Will go to your trading account. Direct expense will go to where? Will go to your trading account. Now people listen. Wages account, wages is what? Wages is your expenses. Expense as what balance? Debit balance as per modern approach. Wages is your expense as per nominal account. Wage all debit all expenses and losses. So can I say wages account is debited? Can I say wages account is debited to wages account, debit to bank account? Can I say wages account is debited? Wages account debit to bank account? No. This wages account, as I told you, is an expense, you are debiting. Bank account, as usual, you are making the payment, so you are crediting the same. Now, how are you going to transfer this wages account? You are going to transfer the same thing by transferring it to trading account, debit to wages account. What are you doing, people? It is similar to your carriage invoice, but the name is different. It is also your expense. Wages account, you have successfully cancelled out this account. This is your expense. The expense account need to be cancelled out. That is cancelled out means to say it need to be reduced. It need to be brought to zero by transferring it to trading account. That is what we are doing. Wages account has been debited. Now we are crediting it so that it has been transferred to your trading account. I hope this is easy. Now, let's move to the sisters, that is sales and sales return. Where let's move to the next one, that is sales and sales return. People, when sales is being made, let's come to it very directly like we did it for purchase. When sales is made, can I say you can make the sales through by receiving the cash or whatever the payment which is there, you can receive it through bank, NEFT, phone pay, GPay, anything, yeah, online transaction, anything, or cash or anything. You can either receive cash, sorry, bank, or you can either create someone called as debtor. People who are debtor, debtor are the people who are obliged to pay to the company or the proprietor or anyone for that matter. If they need to pay, I am selling them the goods. Let's consider I am selling them 10,000 water bottles, finished goods. I am water bottle manufacturing sole proprietor. I sold them 10,000 water bottles. He told that I don't have money right now. You told, okay, it's fine. I'll consider you as a debtor. You keep that. I'll give you time period of some 60 days. You can pay me within 60 days. That is what he has told. You can pay me within 60 days. It's easy. You can pay me back within 60 days. Don't worry about it. Now, bank debtor. Done. Okay. Now let's try to pass an entry when sales is made. Can I say sales, if you are making, it's a finished goods. If you are finished goods, a real account, if you are considering it to be a real account, debit all expenses, sorry, debit what comes in, credit what goes out. Debit what comes in and credit what goes out. What is coming inside the business? You have debited it earlier. What is going out of the business? Can I see your finished goods is going out of the business in the form of sales? So what am I doing? Understand very carefully. Why am I crediting sales as per real account rules? Debit what comes in, credit what goes out. Your finished goods, whatever the sales which whatever the amount which goods which you are selling, it is going out of the business in the form of sales. So I am crediting to sales account. Sales account. Now let's come back to sales account. In this sales account, you can either make the sales through bank or through debtor. bank amount will be directly getting credited into your account. That is, in the accounting terms, your debit balance will increase. Bank is what, people? Bank is your asset. Asset is what balance? Debit balance. If you are increasing your asset, you will debit it. Debtor is your what? Debtor is your asset. If your asset is increasing, what will happen? You will debit it. That is what is happening. That is the reason I told people, if this class, as of now, if you are feeling little difficulty, please go watch the classification of accounts. That is for some 40 minutes or somewhere. Go watch that particular class and then come back to this class if you are not understanding, because it is really very helpful in the matter of recording all the entries. Doing trading account can be done, but understanding why you are doing, why you are debiting and why you are crediting is very important. That is the reason why I am specifying each account, why we are debiting and why we are crediting. So now, this is when the sales is made. Let's consider when the payment is made. Let's consider when the payment is made to debtors. Sorry, not payment. I'm sorry. When the amount is realized. When the amount is realized. When the amount is realized. When the realization is happening, that is, bank account you will get directly. No, when it is debtor, you will get it after some 30 days, 60 days or any days for that matter. If that is the case, in the case of realizable, can I say your bank balance to that extent of debtors is increasing? Like that person you are paid, he should pay now. Can I say that cash you are receiving, imagine that amount you are receiving in the bank or the amount you are receiving as a cash, can I say to that extent of whatever the amount which is being received, your bank account is increased. Bank is what? Asset. Asset increase, debit balance. You are going to debit the same. Now, what is happening with respect to debtor? I recorded him as a debtor because he needed to pay me. He should have paid me. Today he came and he paid. He is no longer liable to pay. Now, can I say to that extent of whatever the asset I recorded as debtor, I should reduce it. If I am reducing my asset, what will I do? I will credit the same. So, now, if you understand this very carefully, people, we have cancelled out this debtors account. Ultimate effect is sales account to bank account. What is the ultimate effect which we are seeing now? Sales account to bank account. Now, this realization we saw. Now, let's try to understand what will happen to the trading account. This is the routing entry. Now, we'll come to the actual picture. How are we recording this in trading account? People, sales, what you have done? You have credited it. In order to transfer the same, in order to make the sales as zero in the sales account, can I say you need to debit the same? That is, sales account is debited. You are transferring it to where? You are transferring it to trading account. You are transferring it to trading account. People, if you are recording this entry, whatever I am specifying over here, as in the ledger of trading account, can I say this will be where will this be reflecting? By sales account. By sales account. Whatever is there in the format, I am just trying to make you understand with that respect of why you are recording that sales on that side only, opening stock on the particular side only, debit side only, on credit side only. The reason behind of that is the trading account entry. And the reason behind why the sales will be debited is that initially you are going to record it in credit. And what is the entire funda we have seen? In-depth understanding. Now, with respect to the next one, we'll come to the small sister who is always dependent on the elder sister, sales written. Sales written is something as similar to purchase written. Purchase written, you are purchasing and you are giving it back. Sales written, some debtors or some people have purchased it from you, customers have purchased it from you. They saw some defects or they didn't find it satisfied, they are returning it back to you. That is called a sales return. If the sales return is happening, can I say you need to pay them back the money? Whatever the money which you have received, you need to pay them back, right? That is sales return. And that when the sales return is happening, can I say the entry for the same will be your sales is reduced. People, normal entry for sales is what? Yeah, debtors account debit to sales, right? Sales is recorded on the credit side. So if there is any addition, you are going to record as credit. If there is any reduction, you are going to debit the same, right, in order to reduce the effect. What you will record on the other side, this is sales return. You are reducing the effect of your sales to that extent of sales return. This is the entry which will be reflecting in your trading account. You are reducing your sales. Now, let's try to understand with respect to the next one, closing inventory. Sales is done. Sales is easily done. This is with respect to trading account, that is sales account debit to trading account. And how are you going to affect the same with the sales return? This is the one. Now, let's move to the next one. Closing inventory. People, listen to this very carefully. Pay close attention. If you want to drink some water, please drink the water. Drink some water and come back to the class. Now, people, what is closing inventory? As I've explained earlier, can I say closing inventory is nothing but at the end of the year, you might have left with some raw materials, some WIP, some finished goods which are not sold. Those inventories which are left at the end of the year are called as closing inventory. Now, can I say this closing inventory is nothing but my asset of the business? Closing inventory is nothing but the asset of my business. If I am recording the closing inventory as my asset of the business, does it not mean it will have debit balance? That is the reason why I am recording closing inventory account debit. Directly, you are not going to put it in some other heads. Directly, you are going to transfer it to where? You are transferring the same thing to your trading account. You are transferring the same thing to your trading account. Now, this is with respect to your trading account entry, closing inventory debit to trading account. Now, you have directly sent it to the trading account, right? You directly recorded the same thing over the trading account. So now let's try to understand. Let's keep it a small understanding with respect to closing inventory when it can be adjusted with purchase. Closing inventory adjusted with purchase. People, if you try to think about logically, whatever the closing stock is there, no, let's consider this as the go down. Okay, this is the go down, this is the opening stock, that is the previous year you have some stocks left, right? That is opening stock. This year you are making some purchase, that is so much is the purchase you are making. Okay, till this you are making the purchase. Now, can I say closing stock is nothing but the combination of opening stock and the purchase which are left in the business for it not being sold. Let's consider these are the total purchase made during the period. This quantity is being sold. This quantity, whatever is there over here, this has been converted into raw material, finished goods if that is the case, or whatever might be the thing, these items has been sold. So can I say whatever the things which are marked in red, These are closing stock. People, this closing stock is result of what? This closing stock is nothing but the result of your purchases and your opening stock. Might be. See, your opening stock, it might be provided over here also. No? Let's keep it very precise. Let's keep it very precise. This is your purchase during the period. This is your opening stock. And what stocks which has been left, what stocks which has been left is so much. Whatever I have recorded it in green, no, those are the stocks which is left, and this stocks whatever has been left is my closing stock. Can I say this closing stock is nothing but the result of your opening stock plus purchases? Ideally speaking, let's consider it to be a purchases here, purchases. It is left out from your purchases. So if you are considering this to be out of from your purchases, is it not ideal for me to reduce the closing stock from the purchase? Can I do that? Yes, I can. What am I doing now? Closing stock account, whatever is there, I will debit it because that is my stock, that is my asset, it will have debit balance. I will reduce it from where? I will reduce it from purchases. I will reduce it from purchases. If this is the case, try to understand the people, the effect which it has in trial balance. Normally in the trial balance, you will not be provided with the closing stock on the other side. This is debit and this is credit. Remember, normally on the trial balance, closing stock will not be provided. The reason behind that is closing stock is nothing but one portion out of the purchase or one portion out of the opening stock. That is the reason you can see the opening stock, you can see the purchase on the debit side. But you will not see the credit side, you will not see anything on the credit side with respect to this one. Now, if in the question, if it is provided, closing stock is also provided in the question. It means to say always remember when this kind of situation comes where the trial closing stock is provided in the trial balance, you are not specifying the closing stock in your trading account. Remember this very well. When closing stock, I repeat, when closing stock is provided in your trial balance, please don't record the closing stock in your trading account. Trading account closing stock is not entered. In your balance sheet, yes, it appears. In balance sheet, closing stock is appeared. Easy as of now? Great. So, this is about the entries which we are recording in our trading account. This is about the trading account. Now, with respect to the entries, let's try to pass one entry, that is compound entry. Like whatever the entries which we have passed, so that we have passed in separate entry, right? Let's keep it very simple. Let's have the life very simpler. That is compound entry. Compound entry here means to say, can I say it is trading account debit? Whatever the entries which are there, yeah. See, you have recorded, no? You have recorded as opening stock. Then you have recorded purchases. Then you have recorded what? Direct expenses. Then what you have recorded? Sales. Then closing stock. You have recorded so much. As of now, don't leave this gross profit and gross loss. Let's come back to it later. Let's do this one. Now, whatever debit you have done, whatever credit you have done with respect to the entries, pass it in a cumulative way, that is in a compound way. This is called as compound entry. So, can I say all these entries which are reflecting, I will be writing it where here. Normally, to opening inventory account, to purchase account, to wages account, to purchase account, to wages account, to freight on purchase account, to freight on purchase account. This is the what? This is the compound entry. This is the compound entry which will be passing. Now, this is the compound entry which will be passing. Now, let's move with the next one. That is the compound, the second compound entry. The second compound entry is sales account debit. Closing stock account debit to trading account. People, as of at this point of time, you should be very much comfortable with what I have taught. That is the reason this is being done little fast. Trading account, no, you understood with respect to sales account why it has been debited. It is just accumulating the entry and passing one compound entry. That's it. Now, people, let's come to the main funda now. After doing this particular exercise of trading account, passing this trading account, you'll be resulting one with the gross profit or gross loss, right? Gross profit and gross loss is a result of what? It's very simple. Gross profit and gross loss is a result of your trading account balances. That is sales minus purchases, closing sales plus closing stock minus opening stock minus purchases minus direct expenses. You will be resulting in gross profit if the credit side is more or gross loss. So the ultimate balance of the trading account will be your gross profit or your gross loss only, people. Please to remember this. The ultimate effect of your trading account is what? Repeat with me. Ultimate effect of your trading account is your gross profit or gross loss only. Now, if your credit side, this credit side of your trading account, if your credit side of your trading account is more, if your credit side of your trading account is more, can I say you will be resulting in something called as gross profit. If this is more, people, if sales is 1000, closing stock is 100, this has resulted to 1100, this has resulted to 1100. Now, your purchases is 600 and your direct expense is 100 and your opening stock is 200. So, how much is the total balance? Can I say it is 200? This 200 is what, people? This 200 is your gross profit. Right? It is just a small example with that aspect. This is your gross profit. Now, if your credit side of trading account is more, you will be resulting in gross profit. If your credit side of trading account is less, then you will be resulting in something called as gross loss. You will be resulting in what? Gross loss. So, now, with that aspect, whatever the gross profit has been specified, gross profit, you are going to transfer this gross profit, whatever you are recording, you are going to record the same, transfer the same, the balance of your trading. You are closing your trading account by transferring the gross profit to your profit and loss account. People, please pay close attention now. Your gross profit is what? Can I say it is your profit first of all? As per nominal account rules, debit all expenses and loss, credit all incomes and gains. This profit, can I call it as gains? If I am calling it as gains, what balance does it normally have? Normally have, as per the nominal account, it has the balance of credit balance. It has credit balance. If it is having the credit balance, then how will the entry for the trading account be reflected? Can I say the entry for the trading account would be like this: trading account debit to gross profit, because this gross profit is your gain as per nominal account rules. Debit all expenses and loss, credit all incomes and gains. This is nothing but your profit and loss. This is nothing but your profit, gain. You are recording it over here. Easy. Now, this is the entry which will be reflecting for your trading account, and you will be transferring the same thing to where? To your profit and loss account. People, how are you going to transfer the same here? You have recorded over here, right? This is the entry which will be reflected. Gross profit you have recorded. Yes, now you understood, like other entry, why gross profit is being debited, because trading account debit to gross profit will be the entry. Now let's try to understand with this aspect with this aspect of how it will be transferred to profit and loss account. Okay. You are reducing the balance of your trading account and you are transferring it to where? Your profit and loss account. Now, try to understand. You are transferring this, you are carry forwarding this one and sending it to profit and loss account. People, profit and loss account, the name itself is specifying that is profit or loss. If you are transferring the gross profit to profit and loss account, where it will go? Yeah, first of all, it is having credit balance. If you are transferring the gross profit, it has the credit balance. Now, if you are transferring it to profit and loss accounts, credit balance. Can I say you will debit the same? That is, gross profit account will be debited. Your gross profit account will be debited. Now, with respect to this one, this is about the gross profit transfer, recording in the trading account and transfer. Similarly, it is for gross loss. Gross loss, can I say it will be reflected over here? If that is the case, can I specify gross loss will be what? Debit all expenses and loss, credit all incomes and gains. So, can I specify this gross loss will be credited? Gross loss will be credited. Easy. With the similar instance of what we have done in gross profit. Excuse me. Apologies for this. Sorry. Now, whatever the gross profit which we have recorded, gross loss is also recorded in a similar fashion. So, this is about the trading account. Concepts in the trading account. So, for the next thing, profit and loss account, for the next part of profit and loss account, will meet in the next part, that is part number 2. What we have recorded is part number 1 of sole preparation of final accounts of sole proprietor. Will meet for the next profit and loss account in part